Remember when Bitcoin hit 75K and there was no dollar liquidity and Trump was standing up against China and Elon was going to fix the government by firing everybody? And then we reversed that in 5 days. And that's when Bitcoin went from 75 to 125,000. I don't believe in the 4-year cycles. I think 2026 is going to be a massive year. And I think the opposite. I think we are setting up for new highs, and that, as the title of this show, the liquidity inflection point. So I'm saying Bitcoin at the turn. So I'm picturing a car turning because we have QT ending. We have QE is about to resume. We have stimulus checks on the road. I mean, we have midterms. The red team has to start printing the money. The financial system will literally fail.
There are moments in every market cycle where the noise becomes so loud, the pessimism so heavy, that investors start to believe the story is over. Anyone watching Bitcoin right now can feel that tension. Price action has been sluggish, sentiment is muted, and the entire crypto market feels like it's stuck in neutral. But beneath that surface, something far more important is brewing. The disconnect between what Bitcoin should be doing in this macro environment and what it is doing is becoming too big to ignore. And according to some of the sharpest macro thinkers in the space, that disconnect is exactly the point. It's the prelude to a structural shift. Jack Mallers, CEO of Strike and one of Bitcoin's most consistently serious macro thinkers, argues that what we're seeing today isn't the top of the bull market. It's the compression phase before the blow-off. In his view, Bitcoin's price isn't weak. It's reacting honestly to a world starved of dollar liquidity. He points out that the US government hasn't yet turned on the money printer, the Federal Reserve hasn't expanded its balance sheet, and fiscal stimulus has been stalled by political chaos. For sound money assets like Bitcoin, that creates an illusion of fragility. But the illusion won't last, because when liquidity inevitably flips, it doesn't just lift Bitcoin, it detonates it. And this cycle's sluggishness makes sense when you zoom out. Expectations for explosive institutional inflows, massive corporate treasury adoption, and a sustained ETF-driven melt-up ran into the hard truth of macro reality. The US is in a liquidity drought. Yields stayed high. Trump's promised monetary expansion hasn't materialized, and the broader financial system has been squeezed tight. That's why crypto hasn't lived up to the parabolic expectations many had for 2024 to 2025. The problem isn't Bitcoin. The problem is liquidity. And when liquidity is withheld long enough, the spring only coils tighter. Maller's thesis is simple but explosive. Bitcoin's current price is a fake-out, a pause, a setup. A market that has already shown it can rip from $75,000 to $125,000 in 5 days, but is now patiently waiting for the political and monetary inflection point that forces the US government to print at scale. According to him, that inflection point is coming, and when it arrives, Bitcoin will be the fastest, purest, and most reflexive asset to respond. So if you're ready to understand why the bull market is not only still alive but dangerously underestimated, make sure you hit the like button, subscribe, and stick around to hear the rest of Jack's analysis. If you're serious about building real long-term crypto wealth, then you need more than just an exchange. You need structure, security, and smart strategy. And that's where iTrust Capital stands out from the crowd. iTrust Capital is the platform designed for investors who want to grow their crypto tax advantage portfolio while having full control. With a self-directed crypto IRA or their premium custody account, PCA, you can invest in 80+ top cryptocurrencies, physical gold and silver, and trade them all 24/7, seamlessly, safely, and simply. Here's why thousands of crypto investors are making the switch. Tax advantages that help you keep more of your gains working for you. 1% transaction fee and no monthly fees, cost-efficient wealth building. Institutional-grade custody that puts asset security first. 24/7 trading access to all supported assets. Multiple funding options, rollover, transfer, ACH, and even in-kind crypto transfers. Fast setup. You can sign up, fund, and start investing in minutes. And this part is important. iTrust Capital eliminates the slow, outdated, and overly complicated systems of traditional IRAs. No more paperwork headaches. No more friction. Just a clean, easy way to move your money into the assets you believe in most, safely and legally. And here's a great perk for getting started today. When you sign up using the link below and fund your new iTrust Capital account, you'll receive a $100 funding bonus. It's an easy boost to kick off your investing journey. Just use the link in the description to claim it. So if you want your crypto strategy to scale into something bigger, smarter, and built for the future, check out iTrust Capital through the link in the description. It's the platform designed for investors who want to grow, not just speculate.
My view is pretty simple. We are living through a sovereign debt crisis, okay? Now, sometimes crisis can be taken to the extreme, like there's a 24-hour margin call where the U.S. has to meet its $38 trillion. That's not what I'm saying. We are defaulting slowly. We are defaulting via inflation. The United States won't actually default. They won't call up their debtors and say, hey, we can't make you whole, because they can make everyone whole, because they can print what they owe. I've given this example countless times on podcasts and interviews, and I'll give it again. A normal person has two options when they're in debt. So a person like you and I, or, to be honest, companies, other nation states even. Those two options are very simple. You can either be an honest person and pay the debt back. Call up your buddy and say, hey, Joe, I know I owe you $20 and I'm giving it to you tomorrow. It's sitting right here in my pocket. And you hand Joe the $20, you expunge the debt. That's option one. Option two is if I have to call Joe and say, hey, Joe, I don't have the money. And I know you're going to hate me. You're not going to be my friend, and you have every right not to be. But I got to default on my $20 debt obligation to you. Those are the two options we have. It's pretty simple. Now, the United States government has a third. They can print what they owe. Okay? It's a very unique option because whilst they can print what they owe, they can also debase and devalue what they owe. So even if you think about it in purchasing power terms, right, the United States can take a $100 debt obligation and they can make it worth less so that it's more achievable for them to actually pay back. And so they'll always be able to make their debtors whole. Always. Always. So the default is not by calling Joe and saying, sorry, man, I know you're going to kill me. You're supposed to stand up in my wedding. It's probably not going to happen at this point. I don't have the money. The U.S. isn't going to do that. They're going to default by printing the $20, giving it to Joe, but by printing it, the $20 Joe is getting is worth less than the debt we actually owed, okay? And so from a macro standpoint, we're in a sovereign debt crisis, and the reason gold is making new highs is because the world around us is repricing itself in dollar terms. Central banks and governments around the world are buying and accumulating more gold, and we've talked about it in specific BRICS nations. China, Russia, India, Brazil. They've been buying swaths and swaths of gold with the expectation that the United States is going through an inflationary default. They have to print what they owe. And if that's true, then foreign nations cannot capitalize on U.S. treasuries and U.S. debt. They have to capitalize on something neutral. They're using things like gold and Bitcoin. If you think about it, guys, like how can you survive an inflationary environment? You survive an inflationary environment by buying something that can absorb like a sponge all of the fiat liquidity, and things like gold and Bitcoin can. And so gold is already telling us where the world is going. That decision has already been made. We are like, you have to understand what I've talked about on the show is these things are happening. They're not about to happen. They're not going to happen. I don't think they're happening. They are happening. Gold has added 10 Bitcoin market caps to its market cap this year. This is happening. It started already. But my second line in this tweet reads, Bitcoin selling off tells us that the system will crack before they're forced to print all the money. And so this gets into politics. Politics is money in the fiat era. You know, a lot of my point that I'm about to make is that the Trump administration hasn't printed the money yet. They've talked about printing the money. They campaigned on printing the money. According to the math, they literally and physically have to print the money, but they haven't yet. This has been one of the driest liquidity chapters in the last, 5 years for the United States of America. Think about this year alone. We started off where Elon was going to doge the place and send us into austerity. And we talked about it on this show, how that was just a moronic idea. And a lot of you are in my comment section, defending Elon Musk like he's family or like you're married to the guy. I mean, give me a break. He's a smart guy. We owe a lot to Elon, but it was a really dumb idea. It would have sent us into the greatest depression that anyone's ever seen. It would have collapsed the world. We would have been sent into rapid austerity and no one would have been happy. And of course that idea didn't work, but it was very anti-liquidity. It was very anti-liquidity. The government was spending less. They were puking less dollars out into the market, which is fine. And then we had the tariff wars. We have the trade wars. And so the combination of the two, that's when Bitcoin on April 2nd crashed. Remember when Bitcoin hit 75K and there was no dollar liquidity and Trump was standing up against China and Elon was going to fix the government by firing everybody. And then we reversed that in 5 days. And that's when Bitcoin went from 75 to 125,000, right? After that, they haven't been able to follow through and print the money. They haven't. So Trump's tariff truce became an untruce, and he goes back to negotiating with China, back to 100% tariffs. Getting the Fed on sides and getting Jerome Powell to actually print money hasn't been successful. The Fed hasn't got on sides yet. The Fed hasn't expanded its balance sheet yet. And then on top of that, the government got shut down. And so the TGA is at its highest balance in years. And so Bitcoin is the only asset class that actually is the best expression of fiat, its current status, both to the downside and the upside. It's the only thing that's telling us the truth because it's the only free market we have left. And so this is a lot of the basis of my view, is that if Bitcoin's going to go through a multi-year bear market, U.S. liquidity and fiat liquidity globally is going to continue to tighten for many years to come. The reason we were in a bear market from, call it 2022, the end of, until 2024, is because they did tighten liquidity, which I'll get to in a second. So this is Arthur Hayes Fiat Liquidity Index. It's a little scratchy visually. It's not the highest quality image I've ever shown you guys, but what it's showing, and for those that are listening on the podcast airwaves, what we're all looking at, there's two lines. The goldish orange line is the Bitcoin price, and the white line is the US Fiat Liquidity Index, okay? Now, the Fiat Liquidity Index is down about 10%. Now, what you can see is that the Bitcoin line went up. So this is called from April earlier this year, and it peaked in, September, October. We had this, $125,000 mark. What did I say our all-time high date was? October 6th, okay? But now you can see the yellow line coming back down towards the white. And my point is, the reality is that the U.S. government has not provided the fiat liquidity to keep this financial system going. This financial system, as we talked about, it only works if they keep printing money. There is no other option. They have no other choice.
Mallers begins by cutting directly into the heart of the issue. The U.S. is living through a sovereign debt crisis, not one defined by sudden default, but one defined by inflationary erosion. As he explains, individuals and corporations only have two ways to resolve debt: pay it back or default honestly. But the United States has a third option: printing the money. And while printing prevents an outright default, it guarantees a silent one through debasement. This is why central banks around the world are buying record amounts of gold. It's why BRICS countries are distancing themselves from U.S. treasuries. And it's why Bitcoin, despite looking weak on the surface, remains the cleanest signal of the system's underlying stress. It is the only asset that trades purely, without manipulation, reflecting exactly how dry global liquidity has become. And that sets the stage for one of the most misunderstood dynamics in the market: institutional flows. Mallers dismantles the popular idea that ETF outflows mean declining conviction. In reality, a huge portion of ETF volume has been nothing more than a basis trade. Institutions farming yield by buying spot and shorting futures. When the trade is profitable, ETFs see inflows. When it isn't, they see outflows. It has nothing to do with long-term belief. Combine that with the slowdown in corporate treasury buying, including MicroStrategy's dramatically reduced purchasing, and the picture becomes clear. Bitcoin reached new highs earlier in the cycle, despite low liquidity, because institutions front-ran what they thought would be a flood of money printing. That flood hasn't come yet, and that's where this story turns.
And I just want to talk about some of the narratives, because part of this is really dispelling what you guys are seeing online of Bitcoin's going to 20K, the bull market's over, 4-year cycles, everyone's an idiot. A lot of everyone's thesis was we're seeing massive institutional adoption via ETFs, and we're seeing massive institutional adoption via MicroStrategy and this whole treasury company phenomena, which I've said 21's not a treasury company. But what we're looking at is the ETF inflows. And I want to kind of just dispel this notion that, certain large institutions were super excited about Bitcoin 12 months ago and are lesser excited now. A lot of Bitcoin ETF volume, sorry to burst your bubble, is a basis trade. So they're buying the ETF and selling Bitcoin futures, and they're collecting the difference. And the reason they're doing that is for yield. And so if you look at, this is the annualized basis that you can collect by doing this trade. And I know that it says Binance here, but it's Binance and the CME are effectively the same. And what you can see are these little spurts of when this trade is really, really profitable. And people do this because it makes you more than the Fed funds rate on these peak moments. And obviously everyone is trying to harvest yield. Yield is a convoluted term, but these large financial shops are trying to harvest yield. How much return on their cash can they get effectively risk-free? The most risk-free is lending it to the US government, because the US government can print it and pay you back. But something that's not too far off is something like this basis trade, where you're buying spot exposure to Bitcoin and you're also selling it via futures. And so you're delta neutral on Bitcoin. You're not taking any directional. If Bitcoin goes down or up, it doesn't matter. You're making the difference. And so you can see these green bars. You see these little pockets of where the green goes up. It looks the same as the pockets of where this spikes. And so I hate to be that guy, but people like Vanguard don't give a about Bitcoin as much as you and I. And hearing me say it out loud probably isn't surprising, but sometimes on Twitter, it gets totally misreported of like, oh my God, Vanguard bought all this Bitcoin. Meanwhile, they refuse to, list it as an option for their customer base. And their CEO at one point was shitting all over Bitcoin. They weren't buying Bitcoin to the ETF to gain actual exposure for themselves. They were running this basis trade. Okay. So I just want to say that right now, if you look at the far right, this is not a time where this basis trade is yielding you more returns than what Fed funds will give you. And so when you see net outflows from the US ETFs, yes, are people less exuberant about Bitcoin? Is the price going down and people speculating on US liquidity? But also it's just because the basis trade is not as popular. And so what you'll see on Twitter is people saying like, oh my God, like institutions are now bowing out. Bitcoin's going to 20K. Retail was exit liquidity for BlackRock. None of that's true. The second is treasury companies. So going back to this graph, what helped propel Bitcoin to new highs while US liquidity was lagging? So Bitcoin was front running US liquidity. The assumption again, Trump's going to print a bunch of money. The US is going to reindustrialize. We're going to find some deal with China. Tell Trump, yo, chill out on this one. We're not going through austerity because you want to run America like a startup. And that just hasn't happened. That hasn't been realized yet. But how did Bitcoin get to new highs without the necessary liquidity? And the answer is these institutional flows, so this basis trade, and also treasury companies. Saylor was buying, at this time last year, Saylor was buying $1 billion of Bitcoin a week. And now he's buying, his purchases have slowed to a screeching halt. Not only that, but to understand the sentiment of these treasury companies is to look at the MNAV. There was a thesis, which I've found always like highly dubious, that, a treasury company can buy Bitcoin and put it on their balance sheet. And because they did that, the Bitcoin on their balance sheet is worth twice as much. And the market doesn't agree with that anymore. And so companies like Strategy, and this is not a dig at any treasury company or Saylor, but the fact of the matter is they're struggling relative to where they were this time last year. And so that level of flows that were coming through this MNAV, and the MNAV that you guys are looking at the screen, so for those listening on the podcast airwaves, MSTR is sitting at $195 per share. 3-month return is down 47%. 1-year return is down 43%. The market cap of the business is $56 billion dollars. And what is the value of their holdings? And the value of their holdings is 59 billion. So they are trading under net asset value. Now, I know it says MNAV 1.2 on the far right. That's the diluted MNAV. So I guess there's two MNAVs. There's the MNAV and then the diluted MNAV. Strategy doesn't show the MNAV. They just show the diluted MNAV, which is more generous to the company. But, depending on how you look at it, the MNAV is either below 1 or on a fully diluted basis, 1.2. But either way, it's trading below asset value. So this goes to show that this idea and the flows that this was giving the industry is no longer there. Going from buying billions of dollars of Bitcoin a week to buying, Saylor's had buys. Again, not that this is a dig, but he's had $20 million purchases. That is a big change in flows. And so what has happened, just being very clear here with you guys, U.S. liquidity has lagged expectations. The Trump administration has not found a way to print the money. They've been very lambastic in trade wars, fighting China, and they have not found a way to give liquidity to markets. They haven't found a way to win a lot of these tariff deals. Still negotiating, still fighting with Jerome Powell.
What Mallers ultimately shows is that the crypto market is not collapsing. It's recalibrating. Investors expected a rapid injection of liquidity from the Trump administration, faster alignment from Jerome Powell, and a smoother political path toward fiscal expansion. Instead, they got trade wars, tariff shockwaves, a government shutdown, and a Federal Reserve refusing to loosen policy ahead of schedule. This combination has pulled liquidity out of the system at the exact moment markets were positioned for the opposite outcome. But here's the key. None of this changes the fundamental math. The United States still must print. The liabilities are too large, the debt servicing burden is too high, and the political incentives point in one direction. The timing shifted, not the destination. Maller's point is that Bitcoin is the only asset telling the truth about this delay. Its sell-off isn't a sign of structural weakness. It's a real-time reflection of the liquidity vacuum that policymakers have created. When liquidity dries up, speculative assets fall. When liquidity surges, they explode. Bitcoin is simply behaving exactly as a free market asset should. But unlike equities, unlike real estate, unlike corporate credit, Bitcoin doesn't need cash flows, earnings, or buybacks to justify a move higher. It only needs liquidity. And liquidity isn't optional. It's inevitable. The political backdrop reinforces this inevitability. The U.S. cannot sustain austerity. It cannot sustain a multi-year tightening regime. It cannot sustain punitive trade wars without compensatory fiscal expansion. And as Mallers stresses, with midterms looming and the political cost of economic pain rising rapidly, the incentives to print are aligning faster than most people realize. When the U.S. finally begins its next round of monetary expansion, whether through QE, stimulus checks, corporate bailouts, or backdoor liquidity facilities, Bitcoin will not need months to react. It will move immediately, violently, and likely without warning. And that's why the fear, confusion, and bearish narratives floating around social media are missing the point. We aren't in the late stages of a bull market. We're in the incubation period of the next major leg up. Bitcoin is simply waiting for the liquidity that will make the next move possible. And when that liquidity arrives, the assets that absorb fiat debasement, Bitcoin, gold, and other sound money stores of value, will be the first to reprice the world. If you found this breakdown valuable, make sure to like this video, subscribe to the channel, and leave a comment sharing your thoughts on Jack Mallers' thesis. Thanks for watching. And stay tuned, because the next phase of this cycle is going to be unlike anything we've seen before.